Market initially welcomed the news of the Fed's third round of quantitative easing, but what about the rest of the world? Market strategist from Washington Crossing, Kevin Caron, joins us live from New Jersey to talk more about this. Kevin, welcome to the show, and I want to start off with what the Fed said in the statement. They said keeping rates low until 2015. Now, overall, the market reaction has been subdued. How should investors around the world look at this new data?
Well, I think what the Fed is doing is they are trying to engineer a very delicate dance. Most of the data in the United States has actually been improving the last few months, and yet here they are going with an additional round of stimulus. I think what they're doing is looking out into 2013, and they're concerned about a few things. First of all, they're looking at Washington, and they're looking at the deficits and the debate over the deficit in Washington. The long-term effects of those deficits are certainly deleterious to the United States finances and the world economy. But secondly, they also are recognizing the fact that to dial back those deficits, to engage in some form of, dare I say, austerity here in the United States, it will put a damper on the economy in 2013. So with the financial system still not fully back on its feet, with credit still not flowing as it should normally, or as it normally does in the private sector, the Fed feels that it's their obligation to continue to keep monetary policy very accommodative.
Yeah, Kevin, I want to get your reaction on a couple of things here. I'm going to roll off a couple of numbers. Just let me know quickly what you think. The unemployment rate, there was talk of optimistically it would drop to 7.4 and 6.8. Is that within your expectation, or is it a surprise?
Well, that would be consistent with the current trend. We have seen over the last 18 months or so a steady decline in the unemployment rate here. It has been a much slower improvement than past recoveries, but along the trend line, that would put the unemployment rate back down to around the 6.5% level that Brent Bernanke was talking about, probably sometime in 2015, and that would cause them to start to think about a different course for monetary policy.
And you know, there's been so much criticism about this, even when QE1 first started, that low rates would fuel sort of commodity prices and then later on inflation. The Fed sees GDP at 3%, but inflation contained at 2.5%. I guess it's a two-part question. One, is that reasonable? And two, should we start worrying about inflation?
Well, we've been hearing about inflation concerns, people crowing about inflation concerns for years now, and there has not been any evidence of it in the data. When you look at the inflation rate here in the United States, it's still relatively modest. Inflation expectations priced into the bond market are relatively modest. You may be able to find a commodity here or there, but by and large, the commodity indexes, which track baskets of commodities, are essentially unchanged and mostly at lower levels than where they were in, let's say, 2006 or 2007. So there is no inflation currently, and for good reason, because the financial system is still clogged. It is still not creating credit the way it normally does, and without the creation of credit, it's very difficult, as Milton Friedman well understood, to create inflation. So we're stuck with this low level of inflation here in the United States, and the Fed is pushing against that.
Kevin, thank you very much for joining us live from New Jersey. Of course, we'll have more on this a bit later. Thank you.